Best Buy has a market cap of $16 billion, a PE of 9.5, and a nice dividend yield of 5%, coupled with continuous consumer demand for their products and proven business model. But with all of that, their stock has still suffered of late. So it begs the question, should we be buying into these pullbacks here? Stick around to find out, as we'll be talking about that and more on today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. Today, we're going to analyze Best Buy's business and earnings results. We'll start with a full analysis into the financials here. We'll look at the top line, bottom line, balance sheet, etc., cash flows, and finally, we'll conclude with an evaluation of this business using our intrinsic value calculator seen on screen, which will identify whether Best Buy is a value investment or not. And if you enjoy the analysis and the value investing perspective, please like and consider subscribing for more of this content. And as always, we'll be doing this analysis within 5 minutes, so let's jump into it. All right, so jumping into their second quarter earnings results here, the first thing we can see right now is that comparable sales did decline 12.1% for this quarter. So that's something we need to take note of when it comes to analyzing this business. But let's jump into the CEO's comments just to get a little more insight on what really happened this quarter. So we can see the first thing that they mentioned is that they are proud of their team for the challenges that they faced over the past few years and to continuously perform even throughout these challenges. Again, that is actually something to be proud of. There has been quite a few challenges, we must say, but this ultimately led to the 12.1% decline in comparable sales. Now, they are saying despite this decline, their online sales penetration at 31% of domestic sales is almost twice as high as the pre-pandemic Q2 fiscal 2020 earnings results, and their diluted EPS grew over 40% since that time. Additionally, they're also saying that they did actually expect their consumer electronics industry to be softer than last year because it was fueled by stimulus dollars and strong demand while everyone was on lockdown. And we already know what they're saying about the macro environment, how it's been a challenge, and that's also put additional pressures on the industry. As for the future, they're saying they're focused on balancing their near-term response to difficult conditions, managing what's in their control, and then also delivering on strategic initiatives, which is important for the long-term growth. Okay, what does this really mean? Well, they're focusing on making changes and evolving their operating model, managing profitability, and then investing for growth here. All right, having read all of that, now let's look at the financials to see what's actually going on in the top and bottom lines here. As you can see, we pulled on our revenue figure. It has decreased year over year to $10.3 billion. Deduct our cost of sales here, and we're left with $2.2 billion in gross profit. This is actually down from the $2.8 billion last year. Deduct for our SG&A, other expenses, and we're left with operating income here of $371 million for this quarter. Now, last year, we actually had about $800 million. So we had a substantial decline here when it comes to our operating income for Best Buy. Okay, and they said the real reason for this is because they had lower service margins, higher supply chain costs, negative forex impacts, and restructuring costs. Okay, ultimately this led to a diluted earnings per share figure of $1.35. Last year we had almost $3. So again, a significant decline here year over year. And we're going to want to see if Best Buy can get back to these $3 in earnings per share figures per quarter, because if they can, we're going to see a lot of upside here for the stock. But keep these numbers in mind as we'll be using them for our calculator at the end of the video. Now let's jump into the balance sheet here. We have $840 million in cash. We used to have $4 billion last year, so they've used up a big part of their cash position so far. And when we compare that to the debt figures, no short-term debt. And when we compare this to their long-term debt figures here, plus this $15 million figure here, let's just call it $1.2 billion in debt. Compare that with the $840 million cash. Yeah, on a relative scale, it's nothing to worry about for investors. But when we get down here to our statement of cash flows, this is where the worry might start, okay? We look at our 6 months ended figure here. We pull down our net income figure of $650 million, add back in depreciation, amortization, restructuring charges, etc. And we're left with $709 million in cash outflow from operating activities. Now, last year, if we compare this to last year's figures, we had $864 million in operating free cash flow. Now we have a cash outflow. So we're actually trending in the wrong direction here for 2022. Not a good sign for investors. And when we deduct our CapEx figures here, it gets a little bit worse because they're still paying the dividend and rebuying shares. We can see what a lot of the cash is being used for here, and that is to service the shareholders and reward them despite the poor performance of the business. That being said, we do have to recognize as investors that this is a challenging period for all businesses. So you have to take these earnings results with a grain of salt. Now let's jump into the calculator to see at what price point, even with these bad earnings, this business can be valued at for a safe margin of safety investment. All right, so when we jump into the earnings per share forecast here from the analyst point of view, we've seen since 2017, we had increased our earnings per share figures year over year. We had a little decline in 2019 for obvious reasons, which was then brought back up to $1.76, then $4. And now analysts are projecting by the end of the year, Best Buy should have about $5.50 in earnings per share. So if we can conservatively estimate here that they will come in with about $5 in earnings per share, that if we require a 10% return, they do pay a nice dividend again. And if we assume that they can get back to these 5-year EPS growth metrics here of 21% for the first 5 years, that drops down to, let's say 12% for the 5 years after that on a 15 PE. Yeah, the stock could be worth about $206 per share. Now, in the very best case scenario, let's say they do grow at 25% for the first 5 years, that drops down to 15% 5 years after that on a 25 PE. Then the stock would really explode all the way up to $375 per share. But in the worst case scenario, and probably a little bit more realistic, let's say their 5-year EPS growth metrics actually decline to, let's say, 7% per year, and then this declines further to 3% for the 5 years after that on a 10 PE. Yeah, the stock will be sitting at $74 per share. We're currently at $71 per share. So that means we're kind of sitting at a margin of safety investment standpoint for Best Buy currently. Now, again, these are just estimations, but again, if the terminal PE actually drops down to, let's say, 5 or something, yeah, it would be sitting at about $60 per share in the worst case scenario. So it really does depend on what the terminal multiple is and at what levels they will be growing. So with Best Buy here, we really have to keep an eye on not only their free cash flow figures, but also their growth metrics. Are they going to be able to get back to that, 20% per year growth rate on an average basis? Or is it going to decline? Because that's really going to impact the valuations. Right now, we are technically sitting at a margin of safety investment standpoint. But with that being said, we are currently in a downtrend right now. As you can see, we're making lower lows and then lower highs as well. So despite this little bounce from our last earnings release, we've now declined almost back to those levels, and we might even take them out and head lower into our, again, green zone down here around $62 per share, which is really a strong buy zone as we've seen in the past. But Best Buy is definitely something to keep an eye on. They are looking to restructure the business, change up their operating business model. They are making the shift to more online sales, and I'm definitely putting this on my watch list. But with that is my analysis for today's video. Again, please make sure to always do your own due diligence. I am not a financial advisor. These are just my opinions. But if you enjoyed the video, please leave a like and subscribe, and I'll catch you on the next one.